Industrial rents are down, prices aren't. Here's why. Industrial real estate across the GTA is no longer riding the pandemic rent rocket, but it hasn't nosedived into oblivion either. Because if you only read the headlines, you would think industrial real estate in the GTA is either collapsing or somehow still behaving like it's 2021. Neither is true. Industrial rents have come off their pandemic highs. Vacancy has crept up. Tenants have finally a little leverage again. And yet, investors are still buying industrial property in Burlington at prices that would have seemed absurd 10 years ago. So, the real question for 2026 is not, is industrial dead? It's, does industrial still work and for who? That's what we're breaking down today. I'm Susan, that commercial realtor. I specialize in industrial and office real estate across Burlington, Halton, and the West GTA. Built for business, backed by data, negotiating with bite. This channel exists to explain how commercial real estate actually works, especially when the market stops behaving politely. Let's start with what everyone feels, but rarely quantifies. Across the GTA, industrial lease rates are no longer climbing. After peaking through 2022 and into early 24, net asking rates have eased back roughly from their $18 net to the mid-$16 per square foot range. That shift matters. Locally, Burlington and the broader Halton West GTA corridor reflect the same adjustment. Availability has increased compared to the pandemic-era squeeze. More space introduces negotiating leverage for tenants. Not dominance, leverage. Vacancy has risen to roughly 5%, up from sub-1% levels just a few years ago. That's not a crash, that's a market normalizing. In industrial real estate, vacancy at this level is healthy. Well-located industrial space in Burlington and the surrounding Halton corridor, particularly near the QEW, the 403, and major employment nodes, that continues to lease at a premium. Location still does matter. What has changed is tone. Landlords are no longer dictating terms without discussion, and tenants are no longer signing first and asking questions later. Vacancy in the low to mid 5% range is not distressed by industrial standards. It's balance. Balance means negotiations exist again. In plain language, rents aren't exploding upward anymore and demand isn't collapsing. Tenants have choices, and investors still find industrial assets compelling because long-term fundamentals are intact. Balance is great until you forget it changes who holds the cards. So let's talk about what this market means if you're leasing space and why it still matters if you're buying it. If you're an industrial tenant looking for 10,000 to 50,000 square feet in Burlington or Halton, pay attention, because leverage is real and landlords are listening. Concessions on rent, tenant improvements, and flexible terms are back in play. Not giveaways, just reasonable negotiations. You finally have room to breathe. Vacancy levels have ticked up modestly, sitting around the 5% range. By industrial standards, that feels less like landlord cave-in and more like a balanced handshake. Lease rates are no longer accelerating every quarter. Incentives, tenant improvement discussions, and realistic deal structures, they're back on the table. Now, this doesn't mean landlords are desperate. It means they're rational again. Smart tenants are using this window to secure buildings that truly work operationally. Power, loading, clear height, expansion, functionality. And well, functionality beats the cheapest rate every time. So tenants finally have leverage. The next question is usually, if the market's softer, why are investors still buying? Well, let's get into that. Investors are still buying industrial property in Burlington at strong pricing because investors still want industrial. Despite rent compression, values remain elevated. Burlington industrial sale prices continue to trade well above historical norms, often landing in the low to mid 300s per square foot range, depending on functionality, location, and lease profile. That pricing would have seemed aggressive a decade ago. Today, it reflects conviction. Investors are not underwriting 2021, they're underwriting durability. What they're paying for? That's simple. Proximity to major transportation corridors, scarcity of well-located industrial land, predictable long-term demand from real operating businesses. Cash flow still matters, but it's no longer the headline act. Cap rates in the mid-5s are common. That's not a get-rich-quick yield. It's a hold-it-and-sleep-at-night return. Across the GTA and nationally, industrial cap rates continue to sit in that mid to high 5% range. Investors with long-term leases are still seeing steady, predictable income heading into the next quarter of 2026. Industrial has quietly become the pension fund version of commercial real estate. For private investors, it's stable, boring, and effective. All of that explains why investors are still in this market. It doesn't explain who actually wins. In 2026, industrial real estate doesn't reward enthusiasm, it rewards precision. Bringing us to the most important part of this conversation, buying correctly. This is where people get it wrong. 2026 is not about chasing upside, it's about buying assets that function. Buildings with insufficient power, poor loading, obsolete layouts, or no expansion potential will struggle, regardless of what the broader market does. Buildings that support modern users will continue to lease, trade, and appreciate faster, even in flat rent environments. This is not a market where average wins by default. This is a market where selection wins. Investors don't panic because rents are no longer growing at pandemic speed. Cap rates in the mid-fives, they're not exciting, but they're sustainable. Industrial investors have always won by weathering cycles. They focus on location, lease quality, and functionality rather than chasing short-term yield spikes. Burlington's proximity to the QEW, 403, and the 407 corridors, that still matters. Location is not a buzzword, it's cash flow insurance. Prices don't stay elevated unless buyers believe demand will still be there years from now. One warning before we wrap this up. In a calmer market, mistakes don't explode, they compound quietly. And industrial buildings are very patient about letting you discover what you missed. Industrial real estate in Burlington, it's no longer overheated, it's no longer frantic, and all of that, that's not a weakness, that's an opportunity. Tenants who negotiate properly can secure buildings that actually work. Investors who buy with discipline, they can lock in durable income and long-term relevance. The market is calmer, the math still works. You just have to know what to ignore and what absolutely cannot be ignored. If this was useful in discerning the facts from the hype, hit subscribe, like, and follow. It tells the algorithm someone other than my coffee appreciates this channel. I share Burlington and Halton commercial real estate insights here every single week. If you want to see how Burlington industrial deals actually pencil in 2026, comment or send me a DM. You'll get real rent comps, real sale data, and real cap rates. No hype, no crystal ball, absolutely no BS. Just numbers that either work or very politely don't. Built for business, backed by data, and negotiating with bite, I'm Susan, that commercial realtor. Now that you know, what are you going to do about it?